purchase my home and assume my loan, what happens is my mortgage, I'm not giving it to you, and you're assuming my mortgage. So if I have a home that has a $700,000 balance on my mortgage, I'm giving you that $700,000 balance, not giving it to you. You're assuming my $700,000 balance at whatever terms I have it at. Maybe there's 23 years left on it. Maybe I took out that loan at a 3.2% interest rate. You're like, I want that deal. Well, so a loan assumption is you assume my loans and assume it at those terms. What loans are assumable? You mentioned VA loans. All government loans have the potential to be assumable. We mostly know about veteran or VA loans because those are the most common government loans. But USDA and FHA are also government loans that can be assumed. So who can assume a loan? Anyone that meets the lender's standards. So if you qualify with the lender that currently holds that mortgage, that VA or FHA or USDA mortgage, you meet their standards for the assumption, you can assume that home. It does get complicated in veteran scenarios. Can a non-veteran assume a veteran's loan? Yes. Most people think no. It can. The veteran that has the loan to begin with has to agree to it, and it can get complicated. And not all veterans are going to want to do that. It does change how they can make their next home purchase. But you don't need to be the expert. You need to know those details. You need to know to ask. Loan assumptions are a great opportunity in a market right now where interest rates are set at 7.5%. And some people bought these homes at 2 or 3% and need to leave the island for some reason, or you want to move to a smaller home, a bigger home, a different neighborhood, and their home isn't moving. The home isn't moving on the market, selling. So loan assumptions are a good thing to ask your realtor. Look at some loan assumptions for me in this neighborhood. Any of these listings have FHA, USDA, and VA loans. You talk to the seller to see, you talk to the agent to see if the seller is willing to allow an assumption. So there's also another factor. Why does the loan balance matter? So if I had that $700,000 balance, I'm selling for maybe $900,000. There's that difference between my loan balance and what I'm selling it for. What does that mean? What do you do with that difference? If you have the cash, that's great. That's easy. You just put the cash in. Somebody you take over the loan, put in $200,000, purchase it for $900,000. Then everyone has that cash. So there are options. It won't work in every scenario, but home equity line of credit, a second mortgage, those are options that people are doing to close that gap. I just learned a couple days ago, right now, Income Federal Credit Union is offering home equity line of credits up to 100% of the value of the home. So if I'm looking to close that gap right now, that's probably the first place I'm calling. I'm not guaranteeing that we're going to give you a loan to close that gap every single time. It's the first place I'm calling to find out if they'll do it for my buyer. So assumptions make sense when the interest rate has increased and you like that interest rate that they locked in a few years ago. Assumptions make sense when people have a flexible timeline. They do take longer. They're at the mercy of a bank, a lender that has a mortgage already in place. Now they need to take their time to give that same mortgage to someone else, and they don't make a lot of money doing that. So they take time. Sometimes it's 45 days, sometimes it's 4 or 5 months. But having the right agent who understands that process, who's done it on both the buy and sell side, who knows how to just call the bank and ask the status over and over again, push it along, that helps. So if you need a quick 30-day to move in, or someone needs 30 days and they have to sell, it's probably not the best option. But again, getting creative, knowing the strategies to just ask what options are best for me in this situation.